Welcome to Counsel Culture, the Business of Law podcast brought to you by Byfield.
Welcome back to Counsel Culture, the Business of Law podcast. Today we're joined by Melinda Wallman, recently appointed Global Practice Leader and Chair of Macrae, a premier transatlantic legal search firm. With over 25 years of experience, Melinda has placed hundreds of partners and teams into top-tier law firms across the UK, Europe and the US. So Melinda, today the topic of discussion is sort of this talent in transition and how private capital is reshaping legal hiring, and then why the UK and the US are playing by different rules almost. So this episode is going to explore how the rise of private capital is redefining legal recruitment, how the dynamics differ between the UK and the US markets, and with your experience advising top-tier lateral candidates and placing talent across global private funds, finance platforms, we want to tap into your insights into why private capital has become one of the most attractive hiring areas, what firms are looking for, and how this is reshaping career journeys. So Melinda, hello, how are you?
Very well, thank you, Olivia. Thank you very much for having me.
Not a problem at all. So to just jump straight into sort of quite a broad topic here, but can you pick out sort of the three main hiring trends that you've spotted so far this year in the UK, and perhaps how this is differing across the globe?
I think the busiest part of the market this year, again, and it was last year as well, has been leverage finance. And then that's actually been the same in the US and in New York and London. And the New York and London markets are often very similar. We're usually just a little bit behind. And obviously other parts of the US are different because the DC market is very much government oriented. And whatever is happening in government is impacting the lateral market. And then the California market is so sort of tech driven that's a different market again. Private capital is very important in California, but it's much more the growth end of the market rather than the large cap end of the market that dominates.
That's really interesting. And in terms of sort of the wants and needs of partners, how are they changing? Or how have they changed in recent years?
I actually don't think that the wants and needs of partners have changed, but I think what's changed is the market. Okay. And so I think that it's harder for the wants and needs of partners to be met than previously. So I think if I look back over my entire career, partners sort of have been looking for the same things. They look for platform, and platform is an umbrella term for a law firm's brand, capability, strategy, quality, rates, all of those things. They look for a firm that has strong financial health and a solid growth trajectory. They look for a firm that has strong leadership and management, and also the right culture that suits them. It has to be a cultural fit. It also has to be a strategic fit. So a partner could look at all of the law firms on the planet and say, yes, I would love to join, name any elite firm, but there may not be a slot there for that person. So you have to find the right platform, but also you have to find a slot. And what's happened in the market, I think two big things have happened in the market. One of them is segmentation. If we look at the global legal services market over the last 20 years and certainly the last 10 years and even more than ever before the last 5 years, the elite firms have broken away from the pack. So it used to be that there was a big separation between the AmLaw 100 and the AmLaw 200. And then it was the AmLaw 50 and the rest of the AmLaw 100. And now it's sort of, the AmLaw 20 or even the AmLaw 10 and the rest. And when I say AmLaw 10, 20, etc., even though the AmLaw talks mostly about firms that grades them in revenue terms, I'm usually thinking in terms of profits per partner, profits per equity partner.
Okay.
And the economics of the elite firm have become so different from segment to segment that even if you find the perfect platform, it's hard to find a space in a firm where you fit. Because if you're coming, and that's the first thing, segmentation. And the second thing, and it has driven the segmentation, is the growth of private capital that really took off around the global financial crisis, post 2008, where a lot of regulation was put in place to manage the banks, which had gone into crisis. And that then led to a trend of private credit and emerging to fill the gap because there was liquidity gap. And if you look at the whole private capital market since then, private credit has actually been the fastest growing part of the market. And these days, if a private equity firm is looking for a loan to finance an acquisition, in the old days, it would go to a syndicate of banks, whether it was, Goldman, Barclays, whatever. These days, they will go to a private credit fund. So they will be or even a syndicate of private credit funds. They could be going to Apollo, KKR Credit, these, and that's a huge difference. And the firms that have those relationships, whether it's on the private equity side or the private credit side or any other part of this alternative asset management group, that's where the activity has been, and that's where the highest growth is. So firms that have had those relationships have been the beneficiaries of growth in the market. And that has then led to sort of a breakaway of the firms that have really strong private capital practices from the rest of the market. I think going back to your question about what does that mean for partners? So partners look for the same things, but the segmentation has meant that if you're looking to leave, say, a mid-market, it used to be that you could leave a Silver Circle firm and very nicely go to an elite US law firm, and you could, there wasn't such a huge rates differential, and there wasn't such a huge, the platform was much thinner at the US firm, but you could make it work because there was flow work coming from the US. But these days, they do different work.
Yeah.
It's not just that the rates are so different, the sophistication of the work that is being driven by these private capital firms is quite different from the mid-market. So it's a much harder move from the mid-market into the elite space.
I see what you mean there. And it seems like a very complicated sort of jigsaw from what you said in terms of what your role entails. Lots of moving parts to really get that to sort of all click together and find that perfect move.
That's
which we can obviously delve into later on in the podcast. So obviously we've talked a bit about private capital there. We've kind of just scratched the surface of it, and it has really dominated the headlines and hiring conversations this year in the UK and the US. Now, for someone like myself, and for maybe people that are listening, can you maybe give us a sort of broad definition of what private capital is, please?
Private capital it's any asset management that is really in a fund. It's a private held fund rather than a public. So it's not the capital markets. The capital markets are public. So, you can buy and sell stocks on the stock exchange. Private capital is held in a closed fund by investors in that closed fund. So it starts with, you would form a private equity fund, and the pension funds or the sovereign wealth funds would invest in that private equity fund. In the old days, there were a handful of large cap funds with, Bain Capital, KKR, Blackstone. These days, there are thousands of them. But anyway, so you'll start with the fund, and then you raise the money inside the fund, and then you've got to deploy that capital. So the private equity fund would then, say, buy a company, and then it would invest in that company and make the company more profitable and fool around a little bit with the capital structure. And then after somewhere between 6 and 10 years, it would sell the company, and the returns would go back to the investors and the management team. So that in its simplest form is what private capital is. But over the last 20 years, these private equity funds, whether, the KKRs, Blackstones, Bains, etc., they have started up hundreds of other funds. So, you've got your emerging markets fund, you've got your European fund, and that could still just be private equity. And then within private equity, they have then created specialist funds to invest, say, in infrastructure or technology or life sciences. And then you've got your growth equity. So these are less mature companies that they're investing in. You have a growth fund. And then on the other side, you've got debt funds. So all of these funds have now developed debt funds where they're actually, instead of investing in equity in a company, they're actually lending money. So like a bank. And so, and then you've got everything in between. So then you've got your TACOP, special sits, everything in between. So private capital just really means fund.
Okay.
And it's a closed fund that is then deploying capital in one way or the other. But the really tricky thing is now that private capital is joining up with public capital. So the latest trend is something called retailization, where you'll have a fund like a Blackstone doing a deal, say, with a Vanguard, so that you or I on the street can invest in one of those funds.
Okay.
Like we would in an ETF or something. So
Wow.
it's so sophisticated and so huge and growing so fast. And that's then, of course, driving demand in law firms.
Exactly. It seems to be snowballing at an incredible rate. And I mean, every time that I Google it, there's thousands of articles that come up just within that week. Bloomberg's all over it, Reuters are all over it. It's, there's another take and another private equity firm that will they do it again sort of thing. So it's so interesting. And I suppose this private capital then touches lots of different sort of practice areas, and this kind of cross practice, as you said, if it touches tech, if it goes into debt. So in terms of recruitment trends, how is this sort of translated, and what are the sort of differences then in terms of the UK and US, because we know that they're slightly different.
I think I actually think that what we're seeing in the US and the UK is quite similar. I think if we speak to our colleagues in New York, which we do constantly, we're seeing the same trends there as we do here. It's just that we see them there first. And then if you look at retailization, for example, that's done under something called the BDC vehicle in the US, and it's in a slightly different structure here. But actually, the structure originated in the US, and then they bring that technology to the UK and Europe, and we do it here. But I think in terms of the demand, it's really interesting. I mean, look, the thing that law firms are looking for the most in New York and London is, private equity partners who have personal relationships with upper mid-market or large cap sponsors that are such strong personal relationships that they can port those relationships with them. Interestingly, we have seen a dip in the number of moves in both New York and London in private equity over the last 12 months. It was a hugely busy area and over the last few years. And I think it's a couple of things have caused that slowdown. I think part of it is there've been so many moves, and there've been so many moves, and everyone's kind of just settling in and seeing how that goes. And then at the same time, of course, there's been so much geopolitical volatility. Interest rates are high. People can't price. So there actually haven't been many deals on. And I think people are waiting for the market to take off again before we'll see the next wave of moves. And there will be another wave of moves. Because there's so much pent-up demand. And also, the private equity firms have to deploy their capital. They can't be sitting on this for that much longer. So everything will eventually move. But in the meantime, what's happened is because the private equity funds are holding on to their assets because they can't sell them because they're not making enough money on the sale. They have to figure out ways to get money back to the LPs, which are the sovereign wealth funds, the limited partnerships. They're the ones that invest into the general partnerships, the private equity funds. They've got to get money back to them. So they've done things like secondaries, where you'll see, and then GP investments, but also things like these NAV loans in the funds finance space, and all sorts of other tricky financing things where you're bringing securitization technology into private credit. And that's just kind of a way to get money back to the investors before you can actually sell the companies or sell whatever the asset is. And that is then driving, a need for partners who have that capability and who have relationships with the funds who are doing those things. But that's the same in New York and London.
Oh, that's interesting. I mean, obviously, private capital is taking off at a rate of not, or has been taking off. It's it's not currently. It is. But I wonder, sort of, how niche our partners' expertise. How niche do the expertise have to be, and what are law firms looking for there? Are they looking for really niche expertise when it comes to, sort of, as you say, the securities, the NAV, the GPs? Are they looking for lawyers that are really sort of knowledgeable in that? Are they common? Or, what's the current trends?
It's really interesting. The firms that are getting it right are the firms that are building, and this is more about private credit than the broader private capital space. But the firms that are getting it right are the ones that are building an entire ecosystem of private credit. So, or even private capital. So you could say, first of all, you need a funds practice, because if you've got relationships with those funds to start with, then you're going to have to figure out that then it'll be easier for you to develop a funds finance practice where it's super active right now. But even if you don't have a funds practice, if you've got a private credit practice where you're doing direct lending for funds, it's not enough now just to be doing direct lending. You now need to be able to do special situations for those funds where you're doing much more sophisticated, trickier, higher risk, higher return kinds of deals for them, where there's kind of going to be some kind of debt and equity component. And then from there, I mean, funds finance can come in there as well. So firms are looking for people who've got all the different bits of pieces of skills, and you've got to put the whole thing together. So the firms in this private credit ecosystem, they want people who've got straight direct lending through to special sits, liability management, restructuring, and also the funds finance piece. And then if you're looking at the direct lending piece, there will be a fund-facing practice, but also a designated practice.
Yeah.
And you've seen firms like Proskauer hire Philip Bowden from Allen & Overy, where Proskauer has historically had a fund-facing practice, but not really done designation. But now the mid-market funds have gone into the large cap space and have been taking designation. So actually it made sense to build a designation practice side by side with the fund-facing practice. And everything's mixing up now. You're seeing the designated together with the fund-facing. But I guess where you need to be careful is when you're talking about the broader private capital world, you've got to figure out which part of that you're going to be operating in. And the firms that are focusing just on private credit, I think, do it more easily because they don't have any conflicts with private equity. But I think we might be talking about that a little bit later.
No, absolutely. Yeah, I think that just picking up on, as you say, how firms are sort of setting up these practices, I want to ask if there's a difference between the UK firms are approaching it and the way the US firms are approaching.
Interestingly, no. It's just that the UK firms need to build their US capability first, because what the ideal scenario is to have transatlantic capability. You want to have a practice in New York and a practice in London that match each other and that talk to each other and that share the same clients. And so if you look at, say, Freshfields, they hired Damien Riddle, who had been at Weil Gotshal, and then they did that first in the US, and they're trying to join that up here on the private credit side. So they had hired Paul Stewart from Weil Gotshal here, but the two of them had been at Ashurst together back in the day, where they did lots of this stuff sort of originally. So that's an example of a magic circle firm building on both sides of the pond. But at the same time, you'll see a firm like, say, a Proskauer or a King and Spalding trying to do the same thing on both sides of the pond. Yet, I mean, King and Spalding hired their fund finance team from Cadwallader. The Sam Hutchinson team, they did that first before doing it in the US. I think firms kind of look for where the opportunities are.
Yeah.
They know what they need to get to. They know what the whole ecosystem looks like and which bits are missing. And the lateral market is so fluid. I think they will just hire whatever bits they can when they can. But with this vision of joining the whole ecosystem at some point in the near future and on both sides of the pond.
And from
It's
your
quite
own
a big
personal,
project.
yeah, oh, absolutely. And from your own personal sort of perspective, do you think that's the right route?
I do. I think that the firms that will do best are firms that have capability in New York and London and that have built out the whole ecosystem. And the hard part, of course, which is always the way with lateral partner hiring, is integration, integration, integration. You know, the recruitment part is just part one, but you've got to get the teams to gel, not just culturally, but also strategically. So you've got to get all the clients to match without conflicts, and to get all the teams to work seamlessly together, not just in London, but also in New York and then across the pond. That's the hard bit.
Wow. And do you have any sort of examples of how you've done that?
In terms of how we just help firms on both sides of the pond, either where they have asked us to run a search where we map out the market and tell them who are all the key players in each area, who their clients are, and what their specialist skill set is, and who we think might fit well together. So we actually do the mapping for them to show them who does what and how it all fits. That's part one. The second part is you've actually got to successfully recruit. And when you recruit, we run a hybrid model. So it could be that they've retained us on a search, or it could be that we're representing an individual and we always know where all the opportunities are in the market on both sides of the pond. And we know the strategies of all the firms on both sides of the pond. So we can either do it candidate-led or we can do it client-led. But I think it's about having the big picture of who's doing what and where they're going, and having a view on who will be successful and helping candidates to understand that.
Exactly. And I think, you know, it goes without saying that the transatlantic piece there for you guys is essential, and in this field especially. So in terms of lateral partners or teams, are you seeing any move into the private capital space from adjacent practice areas such as leveraged finance or restructuring?
Yeah. Every leveraged finance partner calls themselves a private credit partner now. So yeah, we've definitely been seeing that. And that always happens in law firms. I think the skill sets, it's the same skill set. It's just that the client base is different. So it used to be that a leveraged finance partner was acting for a bank, but now they're acting for a fund.
Right.
I think where you need to be careful there is, and this is where private equity meets private credit, you've got to figure out what side you're acting on, because in private equity, you'll have the private equity fund who will engage their lawyers to act for them on the financing. So they're acting for the sponsor, and then either the private equity fund or the lawyers will designate who's going to act for the lenders. And that was pretty easy when the lenders were banks, because it was clear that someone would act for the funds and someone would act for the banks. But now, actually, it's all funds. And even though the credit fund is different from the private equity fund, you're moving into a space where historically the private credit funds did not take designation, i.e. they chose their own counsel, but now they're taking designation. And I think the lawyers who historically have appealed to funds for really sophisticated private credit / special sitsy types of deals are usually a different set of lawyers from the lawyers who will take designation. And so I think it's become a little bit murky in that regard. And I don't know what will happen there. Will it be that you'll always have your designated team and your fund facing team, or will you end up in a place where you'll have the same people just doing different deals with slightly different style of lawyering for each deal? I think that's probably where it's going. But at the moment it's moving so fast, nobody's quite sure.
I was just about to ask you, what do you think about that yourself? So yeah, I mean, as you say, it's moving so fast that it's difficult to almost to tell how firms, but I mean, obviously with your insights, you've kind of probably got the best knowledge to say where it's going to go. And a lot of firms are sort of, as we've just spoken about, they're really doubling down on this area, and they're setting up a new practice altogether, and they're hiring laterals from all over. Certain, whole teams are going and moving to different firms. And then maybe some firms are a bit more cautious. What are you hearing in terms of sort of strategic intent?
I think all firms have most of our clients. So whether it's the AmLaw 50 or the top 20 UK firms have an appetite for private equity and private credit and funds. In fact,
Yeah.
I'm not sure I can think of a firm that doesn't want that. So, and obviously different firms have different risk appetites, and different firms have, and every firm has a different platform today. So they'll have different needs. A firm that has a very strong funds practice already may say the only thing that we're missing is retailization. Whereas a firm that doesn't have any funds capability at all needs, at least one very broad-based funds partner, which wasn't really the case historically. But now, because of the rise of private capital and the need for fund structuring capability in most corporate deals, every firm needs, some kind of funds capability.
Exactly. I mean, it's an undeniable sort of flow of cash, isn't it? You would be silly not to even look into it, and to begin thinking about it. And obviously, we can't really speak about this sort of topic without talking about money. So in terms of compensation, how does it differ in the private capital space between the US and the UK, if at all? And how is that shaping candidate decisions?
I think in general, elite US law firms are more profitable than elite UK law firms. That's all public data.
Yeah.
And US law firms, they've got bigger balance sheets. They can pay more.
Yeah.
But interestingly, if you look at what the Magic Circle firms are doing in terms of their New York hiring, they're digging really deep to try to attract talent, and they're also paying premiums to people in the private capital space. I think across the board, private capital lawyers who have attractive clients that they can bring with them will fetch a premium either in New York or London.
Absolutely.
Yeah. But the US firms in general can still pay, the elite US lawyers can in general still pay more than the elite UK firms.
So would you say that is that a major attraction, would you say, for sort of the candidates that you have at the moment? Or does it come down to maybe other things like culture, or, obviously apart from, the fact that you're obviously moving across the pond either way?
It's not really about the compensation. It's about the platform and what that means in terms of the growth opportunity for the partner's practice, which then results in financial reward. So it's not like they're going for the money, they're going for the growth opportunity, which will be rewarded by money.
Yes, exactly. Okay, that's interesting to know. And I mean, I think I already know your answer to this one. In terms of sort of private capital hiring, do you see it as a sort of a short-term spike, or do you see it as a sort of structural shift in legal recruitment?
It's a structural shift. And we've seen already by the segmentation in the market, which has worked in favor of firms that have strong private equity, now private capital practices, that and again, we've seen elite firms now that have historically not engaged in lateral partner hiring, looking at hiring because they need to get into the private equity / private capital space. So this is a structural shift, and it's not going away. And I think this will keep us busy for years.
Yes, exactly. Well, I was just going to say, we could maybe do a part 2 to this at some point. And I have one last question for you here, which is, what advice would you give to lawyers looking to position themselves for opportunities in this space, whether that's in London or New York or elsewhere?
I think they need to decide what part of the market they want to play in. So if it's, plain vanilla direct lending versus, complex special sits, they really want to play in the designated lending space and position themselves well within that space, and then really think carefully about what is the right platform to go to. I mean, it's all about riding the right horse. Your clients will get better service, better opportunities. Everyone will do better if you're on the right platform. So I think it's deciding what you want to do and then getting to the right platform so that you can build your practice and serve your clients and succeed over the long term.
And this is a totally personal question here, but if you had the choice, what would you do? What avenue would you go down?
If I were I was a terrible lawyer. I was a corporate lawyer. Yeah. So yeah, I mean, it would have to be large cap PE. I think that's where the money is. But you wouldn't want me advising your client.
Oh, brilliant. That's great. Well, I mean, Melinda, thank you so much for joining me today. It's been an absolute pleasure. And I'm amazed at the amount of knowledge and the complexity that goes into it all. It must be sort of mind-boggling. I mean, you're dealing with it every day, so it's obviously not for you, but it's very, very impressive to hear it from the inside and the horse's mouth. So thank you.
Thanks, Olivia. That was good fun.
You've been listening to Counsel Culture, the Business of Law podcast brought to you by Byfield. Thanks for listening. Don't forget to subscribe and join us again next week. We'll be discussing some more of the biggest stories in the legal sector.